A retirement income from a life insurance policy? Is this possible? Can you even do this? The answer is yes. So how is this done? So within life insurance, specifically a whole life insurance policy, there's something called cash value that accumulates. Call it your policy piggy bank. So any money that ends up in your policy piggy bank actually earns a guaranteed rate and dividends. So in time, that money grows and it compounds on each other. Many individuals like yourself, the policyholder, will elect to have a portion in time where they will want to take out withdrawals from their cash value. This can be whenever they want, or they can have it done on a yearly basis as well. This goes way beyond when they are done funding the policy or when they are done working secularly. So yes, you can take a retirement income from your life insurance policy. You can also elect another interesting option. So remember, every dollar is earning a guaranteed rate and dividends. You can actually elect to have the dividends paid out to you, the policyholder, instead of it remaining in your cash value component. You can take that check and you can use it as a retirement type income. Or even if you're still working, you can still have the dividends paid out to you via check. You would just have to let your insurance company know this. So what are some of the drawbacks to these two strategies? So one, let's talk about taking a retirement income out. So since you are withdrawing money from your policy, something has to be collateralized, right? What is it? The death benefit. So as you are taking money out from your cash value life insurance component, then your death benefit is starting to slowly erode and be eaten away as well. Many individuals say, you know what, I don't even care. And that's fine. You don't have to care about the death benefit. You can use the cash value as the living benefits, but just keep in mind the effects that it would have regarding the payout to your beneficiaries after you pass away. If you don't care, that's completely fine. So what is the cons of the second approach, where a portion or the dividends are paid out to you via check? Well, since the dividends are not in your cash value component throughout the years, that means that the uninterrupted compounding growth would be hindered somewhat. Why? Because you're taking out a portion of the dividends. If those portions were left in your policy, that would continue to stack up and you would see compounding growth over the years. So that's another con that you can think of as well, if you like to even think of it as a con. But those are two different approaches that individuals like to take if they want to have a payout, even if they're not even retired. So these are two great options to consider: retirement income and also to have a dividend check come to you when you would like. But the most important thing, if you're trying to employ these two different strategies, is having as much cash go into your cash value component as possible. We want to minimize the base premium and we want to maximize the cash allocation, like always, so that you, as the policyholder, can practice what's known as infinite banking. Call us today for more information. Brandon here saying stay healthy, stay wealthy. Continue to comment. We love to hear your feedback. Thanks so much, guys. Thank you so much for watching. If you like this video, make sure to like, subscribe, and comment below. If you would like more information, visit us on the web at infinitewealthengine.com or click on the link to receive your free PDF on how to build your own infinite wealth engine using the infinite banking concept. We look forward to talking with you soon. Brandon here saying stay healthy and stay wealthy.